welcome to our Altos Trading live strategy session with Jeff Tompkins. This is your host, Richard Van Rich, and we got Craig Ward with us here in the chat. It's a holiday week. Hope everyone's having a wonderful week so far. I do appreciate you guys coming and being with us here tonight, knowing that probably a lot of things going on this week in our lives personally, a lot of travel. So we're excited to have you guys with us. If this is your first time on, you'll notice that your microphones are muted, and that's so that you can hear Jeff and I talk. But there is a Q&A box that you'll find at the bottom of your screen if you just move your cursor. And you can put any questions in there, and we'll answer those throughout the evening, periodically, and also before we sign off. If you do have to hop off for any reason or you get bumped, don't worry, this is recorded and will be available in the members area later tonight and sometime tomorrow on YouTube. And if you're watching us on YouTube, please like and subscribe so you can get more of our future videos that we're putting out every Tuesday with our sessions. Before I bring on Jeff, let me just read the disclaimer. Altos Trading LLC Trade Transilient software is intended to be used as an information service for subscribers and includes opinions as to buying, selling, and holding various stocks and other securities. However, publishers of Altos Trading Trade Transilient software are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber or in view of the particular circumstances of any particular person. Altos Trading LLC, including its owners, do not accept responsibility for any decisions made by subscribers using the software and subscribers to the Trade Transilient software or any other persons who buy, sell, or hold securities should do so with caution and consult with a broker or investment advisor before doing so. And speaking of that, so if you have any questions about your account, access to Trade Transilient, trade alerts, membership, anything like that, email support at Altos Trading, and we'll get to those questions tomorrow. We want to keep the session tonight all about teaching and the markets and all that fun stuff. So with that being said, let me hand it over to Jeff. So Jeff, if you want to grab the microphone.
Thanks, Richard. Happy holidays, everybody. Welcome.
Happy holidays.
Yeah, it's coming up quick.
Are you still shoveling snow or what?
Thankfully, no. Maybe over Christmas. Looks like we're going to have a white Christmas here in Boise this year. So.
Wow, that's cool. Does that happen often? Is that normal?
Yeah, it's hit or miss. You know, we have a lot of years where we don't, and some where we do, but I'm not really sure percentage wise how many we have. But this year it's just gotten so cold here. It's everything's frozen. So the last snow we got has stuck around, which is unusual. So
yeah,
white Christmas.
Yeah, the temperature's supposed to drop pretty bad out here. I don't know what about where you are, but I hear it's all over pretty much the whole country. It's supposed to get a pretty nasty cold spell.
Yeah, I think it's La Nina winter. So Merry Christmas, Bob.
Yeah.
Thank you. Appreciate that. Merry Christmas or Happy Holidays, depending on what you actually celebrate Festivus, which is
what's Festivus?
It was created by the Costanza.
Yeah. That's remind me of Seinfeld.
Yeah, it's a Seinfeld thing. Get the pull out of the crawl space and no Christmas tree.
I've heard people do that. That's probably a thing.
I think there are some Festivus celebrators out there.
I think Craig is.
Craig is, yeah. I like that. I like the pull idea. You don't have to water it. Doesn't drop needles.
I know.
It's not very pretty to look at. Can't put ornaments on it. But anyway. What's that?
You probably float him in the pool, though.
Yeah, right. But anyway, yeah, happy holidays to all of you. And this is going to be our second to last weekly live session for 2022. We'll do another one next Tuesday and wrap up this crazy year and be primed for what's to come in 2023. So we're going to look at our key levels leading into the end of December. And there's some very critical levels to take note of, keep an eye on for this week and next week. Just have about a week and a half of trading left this year. Things have transitioned from a bit more bullish to more bearish. We're trading on the major indices near some key levels and averages. So we're going to take a look at those particularly because really, I think, set the stage for what's to come in January and really Q1 of 2023. And then part of that relates to the 36-month moving average, which has been kind of a point of volatility and consolidation for the majors lately, really this second half of this year. And right now it's looking like we are likely to get closes on the major indices below that average for December. We're close on like the S&P, but things are looking more bearish now leading into next year. And of course, with a week and a half left of trading, I think a lot can change in a short amount of time. But as volumes thin out in the markets and people are major market participants are taking time off, and a lot of the directional movements kind of goes away, and it tends to be more chop and volatile, like what I like to call low volume volatile price action tends to kind of set in and dominate kind of during these periods. But being that we're in a bit of a unique time here, it's hard to say kind of what impact lower volumes and some of these critical levels will have in the short term. So we just need to really map those out, keep an eye on them, and listen to what they're telling us in terms of sentiment and direction. And then for tonight's topic, we're going to talk about options on futures. It's going to be a very high level overview and topic discussion. There are more kind of nuances and certainly strategy based topics within options on futures that we'll cover in more detail in future weeks. But I want to spend a little time discussing them and a lot of the benefits that they have as it relates or as it compares to options on equities or options on ETFs or indices. So we'll talk about those tonight, and they're not, they're not commonly traded among retail traders. They're becoming more and more common in the retail world, but I think they're overlooked in terms of a lot of the benefits they provide. And I'm going to talk about some of those key benefits and how I think they might be able to help a lot of you in I guess, whether it's hedging or just speculation or any of the ways that you might use them might help you. And I'll talk about a little bit about how I use them and why I, in many cases, favor them over options on equities. So that'll be our topic. But again, it's going to be high level. We're not going to get real deep into it. It's a complex topic. It is a different market. While the options on futures work in a lot of the same ways options on equities do, there are also a lot of differences. So it'll take some time really and really a full dedicated weekly session to dive into that, and then also as it relates to strategies, and a lot of time to really cover those. And so we'll build on this in future weeks, but for tonight we'll just really do a high level overview, partly because as we approach the end of the year and the Christmas holiday, there are probably a lot of things that are on your mind and things that you guys want to look at. And we've in past weeks spent a lot of time on our strategy and have not had as much time to devote to the ticker roundtable. So we're going to allocate more time for ticker roundtable tonight, so that as we get approach the end of December and the end of the 2022 trading year, you guys have an opportunity to share what you're looking at, and also with ticker roundtable, of course we can look at symbols or whatever you guys are interested in, but it's also an opportunity to ask questions about just general topics. It could be market related. We can certainly run an analysis on any tickers you guys want to look at, but if you're want to have any discussions beyond that, whether it's how that stock in that sector might be relevant to current market conditions, or if it's maybe an earnings related topic or anything related to that symbol, we can also talk about those as well. So just let us know when we get to that point in our session tonight, and then we'll wrap it up with Q&A. So let's go ahead and get over to charts, and I'll go ahead and refresh my dashboard here and take a look at what's going on in the major indices. So we'll start out by looking at S&P 500, which has, of course, over the past week or so, seen a significant rotation lower, and also a break of a trend line. I'm going to draw the trend line for you. Generally, we focus on horizontal support and resistance lines. We'll start incorporating more trend line analysis into our sessions in market analysis as well. So all-time lows, or not all-time, but lows for 2022 were back mid-December, and since then we broke that major downtrend that followed the run-up in June and July. So mid-August, we peaked and then saw a significant rotation lower with new lows again in mid-October, and then from there have rebounded. So mid-October through late November, early December. So we had a really good month and a half run as the VIX retreated from its peak spikes, and had a pretty well-defined uptrend. But now that structure has changed with the recent rotation lower. We've broken some major support levels that we talked about last week and in weeks prior. We've broken a major trend line, as we'll look at momentarily. On the S&P, we've broken the 36-month moving average. Last week, our strategy topic was identifying buying and selling opportunities using two moving averages, and you can see that we've got a cross of our averages at this point, and they're both sloping down. We've also got a volatility expansion. I'll add the Bollinger Bands on here in just a second. So we've got a lot of confluence of bearish factors playing out here in December. So again, last week we talked, and also in prior weeks, about the significance of this 3,900 support level on the S&P, and that if that level were to break, and I warned of this last Tuesday, expect rotation lower into the levels of support that we mapped out last week, and that's what's occurred. So we had the break last week, so that was on December 15th. We got the close below that key 3,900 support level, close being at 38.52.36, and then over the course of the next few days, we've put lows in down below 3,800. Now, 3,800 was another support level that we had discussed, and that I suggested that if we break 3,900 and trade down into that 3,800 level, to expect to find that find some support around that level, which is what happened today, right? So if you look at today's daily price action, we broke down just below 3,800 and then rotated higher with a higher close from the open. So this is now, well, it's still a support level, but it's really a more significant support level at 3,800 to keep an eye on this week. So just like I explained last week with 3,900, 3,800 is kind of this new key level to watch this week and next week. Now, if that one breaks, if we get a close below 3,800, then we're going to expect the S&P to come down into 3,750 as a first level of support below 3,800. And of course, the lower these levels go, the less likely they are to come into play near term. And so I think, 3,700 is going to be significantly less likely to be tested this year, but not out of the realm of possibilities. So these are the key support levels. And we're going to, again, I'm going to put our volatility bands, the Bollinger Bands, up on the chart here in a second, so you can see what's happening there with this volatility expansion. Because when these occur, they tend to reverse around these key support levels. So again, 3,750, 3,700. Are we going to retest the lows from October? Well, almost certainly not this year, right? In the next week and a half, we need a real market crash to get back down there. But based on how December ends up, it could be a real possibility for Q1 in 2023. Now that we've broken these key support levels. So as I've taught in the past and really strongly emphasize, when a support level is broken, which previously at 3,900 was support, it then becomes a resistance level. So it just transitions from support to resistance. If a resistance is broken, it transitions from resistance to support. So this is now a key resistance level at 3,900, right? So why does that matter? My expectation and analysis is if we can get a close back above 3,900 in the next week and a half before the year ends, that's going to create a much more significant bullish case for the markets. If we remain below 3,900, and certainly if we break some of these lower support levels that we've just mapped out here, it's just going to add to the bearish case scenario for the markets going into next year. So let me go ahead and I want to point something out here as it relates to volatility expansion. Add this on here. And let's go ahead and add on our Bollinger Bands. Okay, so our blue outer bands are a 2 standard deviation move from the average, the center band here. So really we just want to pay attention to this lower band because price is now moving, trailing the lower volatility band, and they're diverging. This is, again, what we've covered in past sessions, our slingshot setup. So whenever we get price trailing the lower band, that's a bearish scenario, but also a case where when we do find support, and that could be, time will tell, obviously, could be the 3,800 level. This is not a very, if you look at the range of today's price action, the high and the low, you're seeing we're actually starting to get some volatility contraction. So there's not a lot of conviction around this reversal day that we had with a lower open from yesterday's close and then a higher close. So we call that a reversal day. But it's off a key level. And, if this ends up reversing back up, it would be a pretty shallow slingshot and volatility expansion. But if we look at the level before the volatility expansion occurred, so prior when volatility was relatively flat, that level resides right around 3,900 as well. It also corresponds to our 9 EMA, and there's a lot of confluence of both static and dynamic levels. So this 3,900 level, again, is really crucial. And if we do rebound and we get a bit of a relief rally from this recent sell-off, that level, as it relates to the volatility expansion level, the 3,900 support, or sorry, now resistance, would be a likely area to move back up into, but a difficult one to break. So the higher probability is that if we do have a relief rally this week or next week, it would be up into that 3,900 level, followed by a resumption of the downtrend. But if we do get a close above 3,900, that's again going to be the bullish case leading into 2023. So next week's going to be really critical in terms of analyzing these levels and where things sit next week as we get closer and closer to the end of this year. So I wanted to show you that on with the Bollinger Bands. Take those off. All right, now for the NASDAQ 100. So let's take a look at the Qs. Right, so the rotation lower has been much deeper on the NASDAQ, and we're coming down into some strong support right around 267. 260 is another support level. So as it relates to today's closes, and we got a reversal day on the NASDAQ 100 as well, but again, not a lot of conviction, and we see volatility subsiding with more narrow high-low ranges. These are really going to be our key support levels to watch for this week and next week on the Qs, with resistance right around 280. 280 on the Qs is kind of like our 3,900 level on the S&P. It's a significant one, but you can see how the uptrend structure was really broken here, right? This upward trend that also began back in mid-October on the NASDAQ has really been broken. Okay, let's see what the VIX is doing, and then we'll look at the monthly 36-month EMA. So VIX is, zoom out here a little bit, coming down. So what does that tell us? Well, we had a 2148 close on the VIX today. It already experienced its spike up into that 25 level. We talked about that one last week, right? Resistance. And it's retreated from there. So we're seeing volatility come down, right? So that might give us an indication that this recent sell-off is subsiding, losing steam, and maybe primed for a reversal off those support levels that we encountered today on the S&P and the NASDAQ. But I think it's important to exercise caution in how we trade that potential reversal, because it may not have a lot of legs if it occurs. Right. So where we end up on the VIX is going to be crucial as well, where we end up by the end of this month, leading into 2023. So if we see the VIX continue to remain above the 20 level, then, and we see these support levels on the major indices continue to be tested. Again, we'll revisit as we move into January, but going to be more bearish for the markets leading into 2023. So if the current structure remains intact, it's probably going to be a bit of a bumpy ride in Q1, but and we certainly could see retests of the lows from mid-October. But I think that could also create some buying opportunities when and if that occurs. So if we look at the monthly chart of the S&P with a 36-period moving average, so this is our 36-month moving average that we've been talking about a lot this year. So we're getting a lot of volatility and rotation around this moving average, right? And this is unusual. We don't tend to see on a monthly basis, on the major indices, a close with a lot of conviction above or below, as we've continuously gotten. We're on the S&P, we're closing below, closing above, haven't closed out the month yet, but potentially closing below this again this month. And again, this is another instance of confluence with the other bearish variables we're talking about. So we're going to watch this very closely for indication of market sentiment going into 2023. Now, the moving average, the 36-period moving average currently resides at 3857. So again, that 3850 to 3900 zone is critical to give us information of whether to side with the bulls or the bears going into January. Also 3800, as we talked about. So if we get a close on the S&P below the 36-period moving average on a monthly basis by the end of December, it's going to open the door for a much greater likelihood of that retest of around 3,500 lows in. And I think it will happen pretty quickly if that occurs. We could see it easily in January or February. So these are very important things to watch as it relates to key levels and moving averages and volatility and things, as they will really give us a good indicator of which direction to directional bias to build our strategies around. So right now it's looking much more bearish than bullish. And Keith mentioned with the likely upcoming interest rate increases, that's going to obviously have an impact on the markets. Just remember, the markets tend to recover from those, especially when they're expected much more quickly than the economy itself will. So it'll do more lasting damage to the economy than it will the market. But the market, of course, tends to react more quickly, more dramatically, and as far as percentage sell-offs, the magnitude of those can be extreme in short periods of time, where they impact the economy on a longer timetable, and the market tends to front run that recovery. So those are our key levels for this week. And again, it seems like almost every week on our weekly sessions, we're encountering one of these levels. So again, on the S&P and the NASDAQ, we're at these key support levels, and using those levels with the analysis on the VIX and how the VIX is behaving can give us very good. And if you go back and watch past weekly session recordings, you'll see that how reliable they are as in terms of telling us the likelihood of a reversal point at a key level, or so that's why we spend time on this. And I think really if you use it for an analysis tool to help make trading decisions, it can give us a really tremendous edge in being on the right side of the direction. So any questions there, Richard?
Let's see. Johnny was just saying earlier when you were looking at the S&P, it was looking kind of like it was forming a head and shoulder pattern.
Oh, on the daily?
Mm-hmm.
Let's take a look here. Yeah, I mean, it's kind of like the high here. It's 41. Yeah, it's kind of an atypical one, but yeah, it does pretty much qualify as a head and shoulders with the neckline around, again, right around 3,900. So I think very near term, there's a chance, just because this 3,800 support level is quite strong, that we could get a relief rally back up into the neckline. But this is going to be I just can't, I'm probably getting sick of me saying it, but I can't stress this 3,900 level enough. So, again, if we close below 3,900 and on the S&P at the end of 2022, that's going to be a difficult thing to overcome leading into 2023 for the markets. And again, the more we test some of these lower support levels, and certainly if we're breaking them and moving then down into the next lower support level, it could get ugly again before it gets better. But it can also create buying opportunities for us.
Ari was saying, like, maybe if you looked at it more like on say a weekly, like where the August, around the middle of August would be the head, and then you've got a shoulder
Oh,
mid-December and mid-June.
Yeah, that's definitely a big one, because yeah, which neckline there, we're really looking at getting down around this could qualify as well, the 3,800 level there. Yeah, that's why be careful with this too, and watch the VIX tomorrow. If the VIX continues to come down and this 3,800 level can hold, then it's going to be much more likely we rotate higher up into the next resistance level at 3,900. If this 3,800 level breaks and we start to see the VIX rise, then watch out. This sell-off could get much deeper. So yeah, I think the probability of touching, and always remember, guys, we've taught that in past weeks. You can go on to an options chain and look at probability of touching any of these levels by a certain date in the future. So we can actually look at the math and the likelihood of touching any of these levels at a point in the future. We covered that in past sessions. So that's something, we don't add into our weekly market analysis, but something I definitely use. So, if I'm setting up a bearish strategy and I need, for that strategy to give me the right risk reward ratio, and if I'm using options, to create the move I'm looking for, I always look at the probabilities using the options chains of touching or closing past a certain price by a certain date and time. So if you haven't been on those past sessions, you can review those on our YouTube channel. But that's also something I throw into that part of the analysis. So if we want to know, like, what is the chance if we break 3,800 that we're going to come down into 3,700? Yeah, we can look at that using actual mathematical probabilities.
That's pretty cool. Ari's has a follow-up. I was wondering Notice that there's not a red divergence cloud yet as we're trading. Does that stick out to you?
Yeah, so it looks like we've broken out of this this bullish divergence cloud. So yeah, absolutely. Let's just confirm that. Actually, it still is in a cloud. It's gotten very faint. Usually when you see the cloud get faint to where on the actual chart it looks like we're out. You can just confirm that by looking at this scanner. We actually still do have bullish divergence, but it's very faint and looks like it's probably gonna either go away or transition to bearish divergence. It hasn't done that yet though. But I am paying attention to that. The fact that bullish divergence is really diminished. And you can see like when that happens in past bullish divergence cases, it can often lead to red divergence or bearish divergence.
And then Henry's wondering whenever we get over to over the platform, you can maybe show the group how to find the probability of touching in the options chain.
Yeah, we can do that. I can actually just show you that real quick. Let's see here. Yeah, so if like if we want to look, we're analyzing the S&P, we want to look at the SPX. We would first select, if we want to know like we're at this key 3,800 level, right? We had a bit of a reversal day off that level. What if it breaks and I want to structure a bearish options trade, or maybe I want to short a component of the S&P or something, and I plan that trade around part of the trading plan is the potential magnitude of the move, right? How if I structure an bearish options trade, for instance, that let's say I do like a bearish put debit spread, right? And I need it to move to a certain level for it to reach my profit target that would give me a favorable risk reward ratio. So I want to know like what are the odds of that? And let's say like I want to set this trade up with the idea that I don't want to tie up capital longer than through the end of this year, let's say. So those are decisions you make based on your trading plan and your expectations. So I might go to the December 30th expiration, and I can also see the expected move, right? So between now and the end of the year, the expectation is the S&P will move up or down by 98 points. Oh, that's interesting. What is 3,800 minus 98, right? That puts us right around into the 3,700 level. So then you can also, and I've already got it up here, but most options platforms will provide this in some form or another, but on TOS, Thinkorswim, you let's see, you can go into the layout. There's I think a couple ways to do it, but the easiest way is to go in up where the column headers are by options chain. There's a layout drop down, and you can go ahead and customize that layout and select what you want in your options chain. And one of those is probability of touching. So you can see I've already added it into my chain, but you can, if you don't have that in there, you can select it, add to your current set of items, hit OK. And that's going to show you your probability of touching percentage. So if we want to know, like if we're in a sell-off and we want to know, like, what are the chances the market's going to go down or whatever, we're looking again at the S&P, but whatever asset we're looking at that's optionable, what are the odd, chances it's going to go down and touch that price between now and December 30th? Well, if we've mapped out 3,700 as the next major support level and we're in a sell-off, what are the chances that the S&P is going to touch that level between now and December 30th? And that's our probability of touch. And you can see that we have almost a 33% chance of touching 3,700 between now and December 30th. Now, that's a pure mathematical probability. It's not taking into consideration all, other analytical factors that we've discussed. So typically, if we're in a significant downtrend and we're breaking key support levels, I would give, in my head, I give more weight and a higher percentage to that, what the mathematical probability is. So like if we close below 3,800, while the math, of course, we're not below 3,800, we're at 3,821, and this will go up, this percentage will go up if we close below 3,800, but I'm going to add some probability of that on top of what the math says, just in my head, because I know there's a greater likelihood. The options mathematical models don't know key support and resistance levels. They don't know, volatility bands, standard deviations, etc. Well, they do. Standard deviations are incorporated to a degree, but a lot of the things that we talk about, I find that these percentages, when I incorporate those other things, are actually greater than they're stated, just historically speaking from my experience. But mathematically, we've got about a 33% chance of touching 3,700 between now and December 30th. So that can be very helpful information. I always look at it when I'm planning my trades and incorporating probability analysis into when I'm building the trade, right? So that's how you find it on TOS. It can be very helpful. And the expected moves are very helpful too, right? Let's actually look real quick what so remember the expected move on the S&P between now and December 30th is almost 100 points to the plus or minus. So if we add 100 points, or let's just say 3,900, what's our probability of touching that? 50%, right? Or even if we add 100 to the current close price today, 38.21, we're right around that would be right around 39.20. Our probability of touching that is 39%. So what does that tell us in terms of mathematical expectations and what the options market is pricing in to the likelihood of the move? Well, the greater weighting is actually on the upside. So options models are telling us that we have a higher percentage of going up and touching that expected move level than we do of going down and touching it. So that's interesting, right? That's mathematically telling me that I might want to really pay attention to this 3,800 support level. And mathematically speaking, the options models are telling me that there's probably a greater likelihood of that serving as a support level and price moving up than this support level breaking and price moving down. So I also compare the probabilities on both sides of the equation, on the call side and the put side. And if you take the equidistant price moves from the current price level, so again, look at that expected move, add it and subtract it from the current price level, and then look at the probabilities at the strike prices at that level, it can also give us a kind of an unbiased mathematical perspective or analysis of what's on a statistical basis more likely to occur. So right now it's telling us. So that's, again, if the VIX continues to retreat and this 3,800 level holds, then if I'm doing a short-term trade, that's I might set, for instance, to expire by December 30th. Do I want to do a bullish or a bearish trade? Well, I'm probably going to want to do a bullish trade with the expectation that those mathematical models are going to give me the edge and greater probability of a bullish move. And then if you add in the key levels like we talked about, those those can also add to our probability of success.
And do you ever look at open interest? That's a second question came in.
Yeah, always. So always look at volume and open interest. Do I look at it as far as more of a bias tool? Not really, because I look at it for liquidity, because it's hard to tell if that open interest, there's so many option strategies out there. It could just be purely buying a put, but it could be a covered call, which, if it shows up at a certain strike, may at first glance make you think it's bullish or bearish sentiment, but based on the strategy, whether it was bought or sold, it's very difficult to tell. And then of course there are multi-leg strategies where those high open interest at a certain strike might be a part of open interest at another strike. So it's very difficult to decipher the significance of open interest as it relates to bullishness or bearishness. Sometimes you can see a big disparity between call and put open interest, and that sometimes can be useful, but I mainly look at it for purposes of liquidity. I want to see a lot of open interest and a lot of volume at the strikes that I'm trading, to make sure, ensure there's adequate liquidity in that options contract.
Okay, gotcha.
Linda asked about any inverse ETFs that I like to watch or trade in a bear market.
Okay.
Yeah, so like the SQQQ, there are inverse ETFs for the major index ETF products. So like the SQQQ is inverse. A lot of these inverse ETFs, what I don't like is they're often leveraged ETFs. So they're really not meant as buy and hold, instruments, but they can be useful for like hedging or taking advantage of very short-term moves. They're subject to beta slippage, so it's definitely not something you want to like buy and hang on to. But SQQ is one that I do trade, which is the inverse of the Nasdaq 100 ETF, the QQQ. So as you see, when the Qs go down, the SQQQ goes up. So that's one that can be used, but there are pretty much inverse ETFs for the index, ETF index products, for sector ETFs, commodities, all those. So this always goes so much faster than I expect, and we haven't even talked about options on futures. We're going to get into those in much more depth, so I really just want to mention them tonight, and talk a little bit about kind of lay the groundwork for why they can be helpful. They are treated in some cases treated differently on a tax basis. So again, that's a very individual circumstance, but they can have tax advantages. But the reason that options on futures, the reason that I like to use them and incorporate that into my trading arsenal is they give us some flexibility that the equity options products don't. One being, so the futures market is it's a 20, it closes briefly in the afternoon each day, but it's basically a 24-hour market, so it trades around the clock. And if you ever like run into a situation where if you follow the futures, or maybe you're trading, you don't necessarily have to trade them, but if you follow them, or you trade just during the US markets, where some products have pre-market and aftermarket trading hours and things, but there's a lot of limitation because the futures drive a lot of the major, the market movement of in general, but like the major indices, where like you don't have something happens, and then after, let's say after the market closes, and you can't do anything because maybe you're holding bullish positions in your portfolio, in your trading accounts, and you want to be able to react to something that occurs whether it's hedge a position or, you know, it could be either direction. It could be bullish or bearish directional case scenario, but then the market's closed. So, you know, out of luck, got to wait for the market to open the next morning. And then, like, let's say something bad happens in the evening, and you wake up the next morning and your bullish positions are all, you know, getting hammered, right? So the nice thing about options on futures is that they, unlike the equities options markets that basically, for the most part, trade right around the regular US market hours, and then, you know, your ability to trade them pretty much goes away until the market reopens tomorrow. Options on futures, you can actually trade. Like if I wanted to place a spread on the E-mini S&P futures, like let's say I'm long positions of the SPY, the ETF that tracks the S&P 500 index, and I'm watching the futures, and oh no, we just broke a major support level on, you know, and that's kind of the beauty of futures is this is the, well, let's go back to it. Let's go to a daily chart. You know, this is the daily close of the S&P, right? But what if this 3,800 level breaks on the S&P futures, right, before the market opens tomorrow? Well, then I'm at the vulnerability of having to wait for the market to open. But now if I go over to the E-mini S&P futures, right, they're already trading for tomorrow. That's why you see the date of 12/21. So it's a live market, right? So what happens if I've identified this key support level, and prior to tomorrow's open, it breaks, and I want to be able to protect, you know, for instance, a long position in the SPY. Well, I can use S&P futures, or is one option, but I can also use S&P options on futures, because I can trade the options on the futures contract while the futures market's open. So I could place a trade right now on the E-mini S&P futures and actually get it executed. So it gives us that round the clock flexibility to trade, you know, for instance, like the major indices, using futures or options on futures when the US market isn't open. So that's one of the big reasons I use these products. So like tonight and before the market opens tomorrow, I'm going to be watching this 3,800 level. If we start to sell off on the S&P futures, I can go ahead and execute a strategy on a break below 3,800 using options, and that's huge. That's a lot of people don't realize they can do that, and it's a big advantage to be able to use this product, the options on futures, when you're not able to trade options on equities because the market's closed. So gives us that's kind of the key point I wanted to mention, and gives us a lot of flexibility there. Options on futures work a bit differently as far as what the option contract controls. So, you know, generally with options on equities, you know, one contract controls 100 shares of the underlying security. Options on futures work a bit different because they control contracts of the future contract, right? So it doesn't, one option contract on the futures doesn't equal 100 shares, right? So that's kind of the key difference. So like if I set up a, let's see, like if we set up, and that can be another advantage. Let me see here. If I were to set up like let's say a credit spread on the E-mini S&P, and I sold a vertical, let's say with, let me just do a quick example here. Get my pen out. Sec. And while I'm doing this, also to mention that there are now micro futures contracts, and a lot of those also have options. They're optionable, so you can trade options on those, which gives us even more flexibility. But let me see. I'm having trouble finding my, get over to, there it is. Okay. So like if I wanted to do a credit spread on the E-mini S&P futures, the let's just say like I sold a put credit spread with a 37.20 strike. So that would be my short strike, the contracts I would sell, and then I bought further out of the money 37.10. So I would buy those. And let's just say, for example, like I did one contract on the spread for a credit. So that credit, let's say the credit is, I think it looks like right now, I'm just looking at the chain on my other screen, is $1.75 at the midpoint, right? So again, the pricing works a little differently. So that would actually be on one contract, a $87.50 credit for putting on this one contract spread, right? And if I were to set the spread up on the SPX using equity index options, right? Each contract controls 100 shares. With a 10-point wide spread, my risk is $1,000 minus whatever my credit is. It's actually lower on the E-mini S&P options contracts, the futures options on futures contracts. So it's half of what it would be on the SPX, right? So just using one contract, if I got an 87.50 credit, while my max risk on a one contract spread on the SPX using equity options would be $1,000 minus the spread. Here it's $500 minus the credit, right? So it'd be $412.50. So it also allows us a little bit more flexibility in terms of risk per contract, which is nice. And this is just on the ES, the E-mini S&Ps. The MES, the micro E-minis, or the micro S&P 500 futures also have options available on. So a lot of the new micro contracts are becoming optionable. So we can also have more flexibility for risk control and position sizing on those as well. So those are kind of a couple of the key advantages of using these. And again, in future sessions, we'll go into more detail on using options on futures and structuring, strategies around them and things. But again, key thing is they're available to trade while the futures market's open and the U.S. equity markets are closed. So it allows you to open and close positions and act on them when the U.S. market is closed. And that can really be a big advantage if something happens that you don't want to be vulnerable to waiting until the U.S. market opens the next day to find out the damage it's going to do to your open positions or your portfolio. So I use these a lot, like as tools to to hedge or to put on positions when the U.S. market's closed. If something were to happen, a key level were to break, or a major news announcement came out that was impacting the futures and going to cause them to gap way up or down the next morning, where U.S. market participants aren't able to act on that using equities or options on equities until the market opens, while options on futures allow us to do that. So again, very high level overview. There's much more to cover there, but we'll dig into that in much more detail in future weeks. But again, just wanted to provide that awareness to you guys. You can even go do some learning on your own, of course, on these, and we'll talk again more in the future. But any questions on that? And then let's go ahead and leave some time for ticker roundtable as well.
No questions there.
Okay. Well, let's go. If you guys want to take a look at any particular tickers that you guys are watching or wondering about.
Me on Tesla earlier.
Was that Tesla?
Yeah.
Okay, let's go ahead and pull up Tesla. Okay. So yeah, interestingly, this Tesla sell-off has continued, but it looks like we broke out of the bearish divergence. So I'm going to zoom out a little so I can see. So again, last week we talked about using the area between our 9 and 21 EMAs as opportunities to buy or sell if we move up into and back out. So there was some very nice opportunities here on this Tesla sell-off using that methodology that we talked about in our session last week. But we've definitely broken. Of course, a lot of this is, I mean, this whole thing with Elon Musk and Twitter and stuff, it's impacting the Tesla stock. I mean, you know, it's just nuts. It's, you know, I don't follow Tesla real closely, but I know that, you know, a lot of this is just emotional selling, probably more so than anything related to Tesla, the company. But yeah, 200 was a really critical level on Tesla that was obviously broken back in early November and then retested. Right, so you can see the break. And again, there were some opportunities in here using the moving average method that we covered last week. There's you know, one, really two good ones. But prior to breaking the 200 support level, there was a good one there, as well as up here. So let's go further out because I'm still not seeing a good level of support from this year. All right, so if we go back really all the way to 2020, that's where some of our key support levels really reside. So 120. So this, yeah, roughly like 145 to 150 levels now broken. So we may see a rotation into the 120 level and find some support there. But the overall structure of Tesla is very bearish. We just broken some of these really strong key support levels on the stock. So for me, you know, there's been some good opportunities with the moving average method, but on the short side, but there's again a support level right around 120 that it would be probably too late, you know, for me to short anything here until I saw either a retracement back up into the moving average zone, or I was looking for counter trend opportunities on a support rejection, and again, that for me that'd probably be around 120. But considering the extreme bearishness of price action of the stock, any rebound until we broke through a couple resistance levels would be more of a relief rally or bear market rally type of scenario.
Cool. Jose says, can you look at Lulu?
All right, so Lulu, I'll be watching 300 for support. 300 breaks, I'd be watching 280 for lower support. If we get a rotation off to the upside off of either of those key levels, be watching 320 for resistance, 330. But if we zoom in here a little bit, right? So we have a bearish cross on our 9 and 21 EMAs. The sell-off is accelerated pretty extremely. So for short opportunities, if I wanted to structure a bearish trade on Lulu, again, we don't want to give us our kind of our value zone or the best or most opportune like zone to sell or buy in. This is where I really like to use the 9 and 21 EMAs. So we do have downward sloping EMAs with the 9 below the 21, a recent cross here back in early December. But we eventually will, mean revert back into in between those. So for bearish opportunities, we haven't since these both since these EMAs crossed and they both were downward sloping with price trading below them. We haven't had a mean reversion back into that zone yet. So I look for that mean reversion back into the zone, and then a subsequent close back below in the case of a bearish setup, the 9 EMA for confirmation, and then that's the criteria that I use to jump into a bearish position with keeping in mind where my key support and resistance levels. So this one's got a ways to go to mean revert back up into that zone for a short option if it meets the criteria. But if it were, and it happens fairly soon, as long as it's not too close to the 300 level while price is still above, because there's a high likelihood of encountering support there, then that could be a potential valid bearish case scenario for Lulu. And then, of course, anything counter trend would again be rotations higher off of these key support levels. So if I see confirmation, we're getting a reversal off the level, and we're to take a counter trend bullish position, then I'm closely monitoring the resistance areas for profit taking. But definitely bearish on Lulu right now. We had a trade trend sell back in the beginning of December with a subsequent trigger the next day. This signal is still open, so there's an open sell, which let's see what price it would have been, right around like 365. Let's see, looking at the dashboard, entry was at 368.97, so actually closer to 367 on the trade trend algo. So this one's already 60 points in profit from the entry, with the trailing stop around 322. So still bearish, but this one's run away, so it's got a higher probability of some degree of a retracement here in the near term.
Cool.
Any others?
All I got.
All right. Okay. Well, I want to thank you guys for, and again, we'll get more into the options on futures down the road. So probably early next year, we'll discuss that some more. So again, keep an eye on those key levels for tomorrow and the rest of this week. We'll have a short trading week. I think, let's see, are we abbreviated hours Friday? I can never remember, Monday, but we'll have some abbreviated trading week. So keep an eye on those for Christmas and then New Year's. So we don't have a whole lot of time left in the year, right? But keep an eye on those levels for tomorrow and the rest of this week. And then we'll meet again on Tuesday for our last session of the year, which I'm excited about. And hopefully will help us set the stage for a fantastic 2023. So we'll plan on seeing you guys next Tuesday. Thanks again. And if we didn't get to your ticker or question, please bring that back for next week if you're able to attend. And of course, our recording will be up on the YouTube channel tomorrow and in the members area tonight, as Richard mentioned. So thanks for Richard and Craig for helping out tonight. Thanks to all of you. Hope you have a very Merry Christmas. Thanks, Rosemary and everyone. Merry Christmas to you too, Ed. And hope you guys have some time to relax and enjoy time with family and friends. And we'll see you all next Tuesday.